All right. Hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall. I'm your host, and I'm joined by Derrick Oldensmith, the head trader at T3 Trading Group and the leader of T3 Live's Pro Desk virtual trading floor. Before we get into any market-related discussions, here's just a quick disclosure of Derrick's current positions as of our recording here on October 27th, 2025. Derrick, happy Monday. How is your day going so far today?
Happy Monday. It's going. I'm down a few dollars today, but I can't be upset about it because honestly, I should be down a lot, and I'm not really down a lot, and that's because I've got short swings on, and there's chatter of a deal with China, and the market gapped up huge. So any swing short I obviously would have had would be out of the money this morning, and some of those things were actually able to turn red on the day, despite the fact that the market's still holding up fantastically well, and I was able to trade a couple things pretty decently during the day today also. So sometimes trading's about making money, sometimes it's about mitigating the damage. Today it's more about mitigating the damage on some of my swings than really generating return. But like I said, I'm moving in the right direction, and we still got a couple hours left. Maybe I can even get green today.
Mhm. All right. I wanted to talk to you about the China news. The the gap up today, I mean, 378 points on the Nasdaq, 1.6%. The S&P 500 up 67 points, about a percent. Dow up 0.5%. Does the reaction from the market today tell you that China and anything related to China and trade is really the news that matters to this market, even with everything else going on, that China is the big thing?
Not necessarily. This market just goes up on any and everything. We were chatting about a little bit on my team this morning is just how the market isn't down on China-US relations turning sour, but they're up when they improve, right? So I mean, to be fair, we did go down on October 10th when the relationship with China soured a little bit, and Trump said he's going to do significantly higher tariffs starting November 1st on China. But even prior to today, we had fully retraced that down move. So the market had already said either this doesn't matter, or we don't care, or we don't expect it to happen. Yet when we get not even a full resolution of the news, the market's able to continue higher. And I still think that has to do more with market structure and market dynamics more than the actual headlines. But incrementally positive news obviously helps the market, and incrementally negative news, what we've seen, does not necessarily hurt the market. So we're up much higher than when the tensions actually got worse, and that's just on hope of a deal actually happening, right? We certainly made progress over the weekend, but there's been nothing inked. There's nothing set in stone. We're hoping that President Xi and President Trump are going to be able to meet and work something out, but there's not even a guarantee that that will happen. But it looks like we're probably not going to get 100% tariffs on China again on November 1st, because whenever there is a threat of a deadline, it never seems to happen. But everyone knew that from the beginning, right? So it's always so impressive that the market's able to continue. With that said, I would note that the market's continuing today, but not necessarily in a healthy manner. Breadth is very poor. The IWM is only at 0.1% as we're having this conversation. So most stocks have traded down from where they opened, even though the indexes have continued to hold up and grind up because of market cap weightings, because of Mag 7, because of money rotating into NVIDIA and a couple of those other names.
All right. It is a big week for the market when it comes to some catalysts that are going to come. Let's start with the Fed, because I think that's probably actually the smallest of importance when it comes to this week, unless we get some kind of like crazy surprise. But we got the CPI last Friday, a little bit lighter than expected. That's good news for the Fed. We haven't gotten a jobs report, of course, still for September, but no signs for the Fed basically that things aren't as they expected them to be here at the end of October. Meeting starts tomorrow. Fed decision at 2 p.m. on Wednesday, 2:30 p.m. being the presser, that being probably the more important part of the day for the market. So when it comes to this Fed meeting, how are you approaching it as a trader, and what do you think the market is focused on? No summary of economic projections here So just a rate decision and a press conference.
Yeah. So, I mean, there's pretty much a 100% probability that we're going to get a 25 basis point cut from the Fed. And what really moves markets is surprises. So there's not going to be any surprise here. We know exactly what's going to happen insofar as the cut. The things to pay attention to with this Fed meeting are one, always the language from the presser. How does Powell sound? Is he leaning more dovish in what he says? Is he leaning more hawkish in what he says? And two is kind of the end of quantitative tightening. Is that going to be ending this week, or does it end in December? That's been the other bigger thing that market participants are looking for, meaning the balance sheet roll-off situation, which is still acting as some degree of quantitative tightening, even as we have gone into a Fed cutting cycle. So those are the big things to pay attention to. You know, the Fed's job right now is probably just to stay the course. But they're not getting the data that they need to potentially change course if things are getting worse or deteriorating. We did get the CPI number last week, and that shows that inflation is increasing, but it's increasing at a fairly moderate pace. It's not getting completely out of control, but we are back above 3%. And the thing is that we just don't know what the deterioration is of the economy and really of the labor market, because we're not getting those numbers. I'm of the thought process that the reason why inflation is not ticking up more than it is because the economy is slowing down and the employment situation is getting worse. You can see that a little bit in the ADP numbers, which are private payrolls, and that's not a number that's generated by the U.S. government. So we still do get that, but we obviously haven't gotten non-farm or unemployment claims or anything like that recently to be able to tell. So, but given what we have seen from ADP, and given the fact that inflation is increasing but very moderately, the Fed is going to probably continue to cut, and they're probably going to be cutting in December as well. That CPI we just got was not so insane to price out a cut in December. As a matter of fact, it did the opposite. It increased the probability for the December cut. So that's what you want to pay attention to. It's probably not going to be a massively market moving event, but at the same time, you never know what's going to happen in the press conference. You never know if Powell's going to make a slip up. I would argue that when Powell was newer as a Fed chairman, we did see him occasionally have some slip ups where he would say the wrong thing in the press conference, and it would really, really move the market. Our more mature Fed chairman, who's been doing this for a long time now, doesn't really ever make those slips. But you do still have the CPI number like a full percentage point plus above the Fed's target. So maybe there's an off chance that he says something that's a little bit more hawkish than the market expects, because we're also seeing inflation continue to move up in October. Again, even though the government numbers are shut down, and they're saying that we're not going to get a CPI at all for the month of October in November because they weren't able to keep the data properly. But you still get some private numbers that come out. There's this Trueflation index that my team and I look at. That's a weekly number that comes out, which just last week gave I think it was the highest week over week inflation increase this calendar year. So you are continuing to see that move higher. And it's interesting that we might not get an October CPI, because if you go back to like Tariff Liberation Day on the onset of those tariffs, and the time that it could take for tariff-related inflation to be seen in the economy, it could be actually about now, September, October, November, December, like this back half of the year. But we might not even get a CPI at all. So it's an interesting situation for the Fed to be in, but it probably means without the data, or with the limited data they have, nothing is getting too crazy, that they just stay the course. Another 25 basis point cut, end of quantitative tightening, and probably some dovish language.
All right. When it comes to a Fed day, often it's, we get these like pops or drops like right on the decision, and then things kind of level out during the presser, and then you get like the real market reaction after Powell finishes speaking. Do you do any type of like scalping or anything during those quick moves when it comes after the decision?
Yeah. So first of all, I would argue that the real move probably happens the next day. So
Mm.
what's happening from 2 p.m. and 2:30 p.m. on for the rest of the day, it's a very short window. It's primarily algorithmically driven. So
Yeah.
Howell says a sentence, and the robots are, reading the words of that sentence and making hyper quick decisions. So a lot of times, it's not unusual to see like a false move higher, and then the real move is lower, false move lower, and then the real move is higher for the market. But you get those reactionary moves initially, and then the real money managers that are out there, they're probably not making any decisions too often, major decisions in that last hour and a half of the day. Really, it's even less than that. By the time Powell is done speaking in the press conference, it's probably 3:15 Eastern. You only got 45 minutes left in the day. Um, they take the night, they digest the information, and then the next day is a lot of times when you get the bigger moves. So what we see is there's a much higher probability of the day after a Fed day being a trend day. So generally speaking, in the market, you can have two types of trading sessions, and there's some nuance here, but generally speaking, you can either have a trend day, market's trending higher or trending lower, an uptrend or a downtrend, or you're having a range day where the market moves sideways. More days in a calendar year will be range days than they will be trend days. If you just like close your eyes and point your finger at a random day on the calendar and you had to make a bet, is it going to be a range day or a trend day, and you know nothing else, you would want to bet that it's going to be a trend day. A range day. There are more range days than there are trend days. But when did trend days typically happen? Trend days typically will happen if there is a news event, or if there's a technical event happening with the market, a technical breakout, something like that. Then all of a sudden you have a higher probability of a trend day. So we find, while it's certainly not 100%, there are no 100% in the market or trading, the day after a Fed day can oftentimes be a trend day. So circling back to your trading playbook for the Fed, first you have the initial reactions. And to directly answer your question, do you put on shorter term trades in that situation? The answer is absolutely yes. There can be really good day trading opportunities post Fed. The first thing that we pay attention to is what I always call, and I do this with any economic event or any Fed event, the starting point. So, what was the price of the market when that economic number hit, when the Fed released their statement at 2 p.m.? And if we're shooting higher, I want to know what that number is on the downside. And then, just very broadly speaking, while we are above the starting point, I would rather be long than short. And if we're ever below the starting point, because either the initial reaction was down or we went up, but then we faded below the starting point, if we're below the starting point, then I want to be short. And then we're just paying attention to the movements and the reactions, right? You might get a really big initial move, and then you get a technical pullback to our smaller time frame equilibrium area, the 8 and 21 EMA on like a 5-minute chart. And then you're looking for the pivot low to come in that zone to create a higher low, basically, for market upside continuation. That a lot of the times can be a good spot to look for a long versus a low, a pivot low, as it establishes itself. Where the exact opposite is obviously true if the market moves down initially. So that's how we trade the initial reaction. And then I have found that how the initial reaction resolves itself for that day does not necessarily translate into, if the day after the Fed day becomes a trend day, it's not necessarily going to be in the direction of the initial reaction that happened post 2 p.m. on Fed day. I've seen it where the initial reaction after 2 o'clock is that we end up higher by 4, and then the day after that we're trending down all day. Obviously, I've also seen it where the initial reaction after 2 o'clock, by 4 o'clock we're higher, and then the next day we're trending higher all day. But I've never seen like a really strong correlation between how we traded and how we moved between 2 and 4 p.m. on the Fed day, and if we actually get the trend day the next day, which direction that trend is. So I always want to be prepared for either direction to come in for the day after the Fed day. We assess how we gap, we assess the opening movement, and then we assess, all right, are we breaking higher and we're moving into that trend? In which case, if you're putting longs on and the market's trending higher, when you circle back to just game planning, right? You have to have a game plan for every trade that you take. Your reward profile on a trade is significantly higher if you are in a market or a stock that is trending. So if all of a sudden it's the day after the Fed day and you catch a really good long setup and the market is establishing itself as an intraday uptrend, that's a day where you want to have a game plan where you're going to be a little bit more greedy than you would be otherwise. And that's going to enable you to maximize the reward that you're having for the risk, as opposed to if the day that you're trending is like a trend day, then you want to be booking your profit much more quickly because there's a lower probability that you're actually going to be able to get the follow through from the trade.
Great. All right, now let's talk about the real news of the week for the market, and that is earnings. We're going to get 5 of the Mag 7 earnings. 5 of the Mag 7 companies reporting earnings this week. Got Tesla already last week, and then we know Nvidia's, way at the end of earnings season always. But tomorrow or Wednesday after the close will be Microsoft, Google, and Meta. And then Thursday after the close will be Apple and Amazon. So of the 5 companies reporting this week, which are you focused on the most when it comes to these Mag 7 stocks?
So I'm definitely focused on all of them. I don't have a position in any of those ones going into these reports, but how the
And
market reacts to them.
if you want to screen share, we can look at some charts maybe on how the action's been headed into the week. We still, of course,
Sure.
have 2 trading sessions for the first and then 3 for till Thursday. So things can change, but and these are all after the market close. So
Sure. So let me start by making some generalizations, and then we can potentially look at some charts.
yeah,
Um, so this is going to be a really important earnings season, and my initial thought process for this earnings season has been the exact same expectation that I had for the last earnings season, which turned out to be perfectly correct last time around. Last earnings season, the market was going into the earnings season at all-time highs. Guess what? We're going into this earnings season at all-time highs. The bar for earnings was very, very low. So everyone in the street was expecting everybody to beat. And that's exactly what happened. But to me, as a trader, it's not just important whether a stock beats or misses. What's important is the reaction to it. So what I've seen, and there's actually data that backs this up, is that let's just take I'm gonna say a broadly good report, not phenomenal, but let's just say you get a report where every number is a slight beat on every number, the backward looking numbers and the forward guidance for EPS and revenue. Everything is a small beat. Everything else held the same, which it never is that way. If a stock was trading down a lot into that small beat, there's a good chance that that stock is going to be trading higher. But if stock was up a lot, up a tremendous amount into it and all-time highs, and you get that good report, a little bit of a beat, we're going to say across the board, there's a good chance that that stock is actually not going higher because it was already priced in. So last earnings season, we were joking by the end of the earnings season and kind of continuing the joke a little bit that the only thing that could make a stock go down is reporting a good earnings report. Because as you can see here, this market is just at all-time highs again right now as we're having this conversation. And we've just been in this upside grind that has been going on for months and months and months. So last earnings season we're at all-time highs. This earnings season we're at all-time highs. So stocks tend to be elevated in terms of their price. So we saw a lot of beats last earnings season, and then the stock stopped going up because it had been going up into it, and it was kind of, really good earnings report was the end for a lot of these moves. So that's kind of been my initial thought process going into this earnings season as well. And we can have a look at some of the charts because not all the next 7 names, like if you look at Amazon, even though Amazon had a pretty good bounce back last week, these are not necessarily at all-time highs in the exact same way that the entirety of the market is. So some of these are a little bit weaker. But I got to put a big asterisk on what had been my thought process here because my thought process is constantly evolving. And one thing to note as we're going into the end of the year right now is when things tend to turn very seasonally strong. November, December, we're going into like the strongest period of the year on average for stocks. And obviously every situation is unique and you never know what news can happen. But generally speaking, November is a very, very bullish period for the market. And we're at all-time highs. And this is the important part, it looks like most institutional investors are underinvested. So while my original thought process is a good earnings report for a lot of these Mag 7 stocks might not be good enough, I'm starting to actually lean a little bit more towards the upside on the potential of some of these reports. One, because again, you look at Amazon here, and we can take a quick look at most of these Mag 7 stocks. It is not at all-time highs, so it's not necessarily as elevated as the stock market is. But two is that it's probably a little bit underowned from an institutional perspective as we're going into the most bullish period of the year. So if you see good beats and good reports from a lot of these companies, you might actually see an institutional chase into them that actually creates a larger upside movement. So I'm modifying my original thought process of good's probably not going to be good enough to good might actually create a fear of underperformance from a lot of the hedge fund community that drives in a lot of new money from those institutions and therefore drives the stocks up. So, and we'll see, especially for the ones that are not sitting at highs. So what are we doing this week? Remind me, Greta. We got Amazon, we got Meta, we got Microsoft.
Wednesday's Microsoft, Google, Meta, and then
Google,
Thursday's
Meta.
Apple, Amazon. So we can, Microsoft, Google, Meta is going to be first.
Yeah, so Microsoft, same thing, and this is an example of what I was just talking about, right? That Microsoft earnings report last quarter was phenomenal. That's the high ever since then. Look at what the stock was doing going into that report, up every day. The only thing that was able to stop Microsoft was a really good earnings report, but it's digested that report for an entire quarter, and the institutions don't own it as much as they'll need to if that report's really good. So we'll see. This chart looks pretty good to me. It's breaking out. They report pretty decently. You might see this thing go up and actually continue. Meta's the exact same deal. Look, this is when this thing reported last. Basically the last day of July. And yeah, we made like one new high after that, but for the most part, Meta has been spending the entire quarter digesting that really good earnings report. There's room for this to go up. There's room for chasing to occur in this name too. And the technicals recently have improved also. Getting back above this like 730, 740 area for Meta has this thing looking pretty good. Google's been a darling of mine. It's been my favorite name to own in the Mag 7 complex. It's the cheapest fundamentally. So here's one that is much higher into the report. But even as this one is making new highs when Meta and Microsoft and Amazon are not, it's still the cheapest one fundamentally when you look at their like forward PE multiple. So here's another one where it's like, it is making highs. So that's the traditional thought process of good might not be good enough, but it's the cheapest one that's out there. So if it's good, you might see multiple expansion as a result of a really good earnings report from Google. And this chart obviously looks fantastic, though at this point, after today, like a bunch of other things, it's moderately extended. Apple also looks phenomenal. Phenomenal. I think technically. And this is another one though. If there was any one of these charts where I would say a good report might not be good enough to get it to continue, it probably would be this one, because it's not as cheap as Google is, but it's also at highs. So it's not like coming from a lower place compared to Amazon, Meta, Microsoft. So obviously all of this is conjecture. I never know what a company is going to report, and I never know how the stock will react with certainty based on what that report looks like. We always get some fun surprises. We'll see what the CapEx spending looks like. We'll see how much money they're putting towards buybacks versus CapEx spending, if we get any new buyback announcements or not. It seems like they're actually pulling back a lot of these companies on their buyback announcements because there's so much CapEx that's ongoing on AI, which is kind of an interesting situation. But I would say, while I can't predict the report, if you were to tell me right now, every one of these companies is going to report a good report that like we were just discussing, they beat every metric by a little bit. This is probably my least favorite one for continuation. But otherwise, I think that they all look good for higher.
All right. Mag 7 higher on earnings. So it's going to be Derek's call for the week. So we'll see. We'll have to check in. You and I will discuss how those earnings went next Monday for sure. So we got lots happening this week, Derek. Like we've talked about, we have the Fed and the earnings. Those are the big things, and then a bunch of data that we're probably not going to get because government's still shut down. Anything else you want to add on this current market and where we're at here at the end of October? As like you mentioned, we head here into the most seasonally strong part of the year.
Yeah, so I guess just going right back to the chart real quick here. I still got my chart of the SPY up.
Yeah.
On Friday morning, I probably gave one of the more bullish morning meetings that I've given in quite some time. We were gapping up, and it's what we call a breakaway gap, which is when the market is breaking out via via gap. So we were getting above the the straight line resistance here in the SPYs, getting above the straight line resistance here in the Qs, and we had just been moderately extended for a while on the way up, but never getting to any extreme extension, and things are just looking like higher. And this is here we are, September and October. You look at this chart. This is like our seasonally weak period of the year. This is the seasonally weak period of the year. Has just been
Yeah.
up and to the right on an upside grind. Now we're getting into the strong period of the year. It doesn't mean that we can't go down. We can go down. You never know what's going to happen. There's a lot of events that are coming up. We got midterms coming up. You still have a government that's in a shutdown, and that maybe someday, somewhere, somehow begins to impact the stock market. Obviously, so far it's had zero impact, but we're starting to get into the point where um, at the end of this month, beginning of next month, you're going to start seeing the air traffic controllers not get paid, and the SNAP benefits are going to be running out.
Yeah.
Maybe that begins to
Mhm.
impact the stock market at a certain point. Um, but the bottom line here is that while an event always maybe could happen, the market technicals look tremendous as of Friday last week. We really look like we're going higher. And unlike February of this year, where the market technicals were breaking out, but there was no one left to buy. There's a lot of buyers that are available
Mm.
to come in November. The institutions are still underweight this market. The corporate buyback bid comes in a huge way in November. So that's going to create a lot of downside insulation into any down moves. And yeah, the systematic triggers are still there that I had been pointing to into this down move. We had gotten just to the cusp of actually triggering some major systematic selling, but we never actually triggered it. But at this point, that's becoming so far away. So you need the market to drop probably 4% to get to the point where the systematic triggers for selling will actually start to come in on this market. That's going to be very hard to do. Not impossible, but it's going to be very hard to do. So overall here, the market's looking tremendously bullish, and I would expect it to continue to move higher at this point into the end of the year. With all of that said, though, it doesn't mean that we chase price, because one of the biggest things that I pay attention to in my own trading is this concept of market extension. And interestingly enough, the way that I study market extension today, today is the first time that we have hit extreme extension for the market since July 3rd. And that is, to me, mind blowing, because it feels like we basically haven't had a down day in months. We almost haven't. We had a period of 2 sell days here at the very end of July. We had the one big down day here on October 10th. We basically haven't had a down day in months yet. This is only the second time since July 3rd. July 3rd was the last time that it happened, that the market has hit extreme upside extension via my metrics. So that's pretty interesting. It tells you a couple things about how this market environment has been. One, it's been a very much an upside grind. Um, no big movements higher, no big movements lower, with the exception of like literally one or two trading sessions. And only now are we actually extending to the upside. So here, this is not a market, as I talk about how bullish things look, where I'm buying this here today. We're just too extended. And if anything, I would rather look for shorter term shorts into the end of the day today, maybe early tomorrow, to satisfy that extension, especially considering that the market breadth today hasn't been that great, than I would to be buying for continuation. But most likely, any technical pullback of this extension through time or through price, that's actually most likely what you want to buy. And I would say if you do get some shorts on this afternoon or tomorrow, and they pay you in a little way, as the market corrects itself, I'm always an advocate for reward maximization. Keep a small percentage just in case something changes. you get an event, whatever, and the pullback actually becomes a reversal. But that's not what I would predict. What I'd be looking for the moment, more than anything, is a buyable pullback or a buyable bull flag. Not buying the gap up today. There's just too much extension for the first time in a long time. But that extension could last for a couple of days also. We could be even a little bit more extended tomorrow. We could gap up again tomorrow. But we're starting to hit a point where the speed of the up move is becoming not sustainable. And we have not seen that at all on the way up until now.
All right. All right, Derek, it's going to be a busy week. Derek is a real trader, so I do want to let him get back to that. If you'd like to get his free ebook, you can go to t3live.com/DO live. Again, it's a totally free ebook about prop trading, the benefits of prop trading, how you can work with Derek himself and his team there in the Pro Desk virtual trading floor with T3 Live and T3 Trading Group. Derek, have a great week. I hope you get some excitement from the Fed and the Mag 7 earnings, and some of your predictions can come true for those earnings for everyone here. So have a good week.
Greta.
We'll talk next week.
I appreciate it. Talk to you soon.
Bye.